Welcome back to another week in markets. George Bell, Portfolio Manager here at True Potential, and joined today by Faye Graham, one of our investment analysts. Faye, quite a lot happened in the markets this week in terms of economic data. One of the key aspects has been the decision of the European Central Bank. What were the key takeaways?
Yeah, so the European Central Bank cut interest rates by 25 basis points, so quarter of a percentage point, down to 3.75%. As expected. Previously they'd held interest rates at about 4% for the last 9 months to help bring inflation down.
Yeah, and have they been successful in doing this?
Yeah, absolutely. So we've actually seen core inflation almost half since the peak, so now sitting around 2.9%. So coming closer to the European Central Bank's 2% inflation target. I suppose the latest round of inflation did maybe present a little bit of a challenge for the European Central Bank, just in how they navigate that decision. You actually saw inflation, headline inflation, tick up from 2.7% to 2.9% over the month, and we were seeing some signs of wage growth and also prices rising further in the services sector as well. So the market did actually start to question whether that rate cut would actually happen just following that data. But I think there were some interesting points that came out in the report as well.
Yeah, absolutely. I mean, Christine Lagarde was quite adamant that the data they were seeing was encouraging enough for them to enact the interest rate cut, which we saw, but being very careful to manage expectations as we look ahead, essentially trying to ensure that the market doesn't get carried away, that we're going to see this linear fall in terms of interest rates, that they would be very path dependent in terms of what they're seeing. And altogether what they're doing is taking interests from what they see as restrictive levels just down at the margin. But it's going to be very data dependent in terms of where they go from here, I think. They also changed the projections in terms of inflation as well. What were the key numbers there?
Yeah, absolutely. So they essentially revised their expectations for inflation headline and core up by 10 to 20 basis points for this year and also next year. They're now expecting core inflation to be 2.8% this year, and then fall in the following year to 2.2%, and then come down again to 2%, in 2026. So they are expecting inflation to come down, but obviously the pathway of the policy will depend on how that data actually evolves.
Yeah, absolutely. And the equity market took the interest rate cut pretty well. We saw a pretty buoyant equity market on the back of it, but it was the bond market which didn't digest the inflation projections being revised up so well. So I think if we look at short-term rates, which are more sensitive to interest rates, we saw yields ticking up around 3 to 5 basis points. And we saw that in Germany, but we also saw it in Spain and in Italy as well. So it was quite a European wide view that higher inflation projections would maybe push out the interest rates more into 2025 possibly.
Yeah, that's absolutely right. And we've actually seen several central banks cut rates this year. So actually this week we've seen the Bank of Canada cut interest rates for the first time. And then earlier on in the year you've had the Bank of Chile and also Brazil cut interest rates as well. But this is definitely quite an important one, marks a divergence from the US.
Yeah, absolutely. I think that's the main thing. It's that divergence away from the US. Currently the market's been of the view that everything's dependent upon what the US do. Well, the Bank of Canada and Europe this week have sort of proven that not to be the case. It's also interesting as we head towards the US Central Bank interest rate decision next week. Certain components of the inflation basket in America are proven to be more resilient than were initially expected. So services are a key example of that, but we're also seeing wage growth as well. And these all present headaches for the Federal Reserve, who are trying to agree upon the point in which they lower interest rates and how much they lower, and to fuel or to inform the committee in their discussions. We've literally just this afternoon had some quite big announcements in terms of the labour market and some updates in terms of the employment figures. What were the key takeaways there?
Yeah, absolutely. So I suppose to set the scene, we've seen, the Fed has been trying to cool the labour market down for the past several months. We've seen very, low levels of employment, high demand for workers, and with that you've seen wage growth as well, which has really been fueling consumption. And consumption actually makes up around 60% of the US economy. So to cool the economy and bring inflation down, you really need to cool wage growth and moderate consumer spending. I suppose the report today out this afternoon showed that the US labour market is actually really proving a lot stronger. So we actually saw more jobs created than expected. So you had 272,000 jobs created in May.
And what was expected? It was around 151,000. So
yeah.
Quite an exceptional, number. Quite a big miss. Demonstrates the challenge of estimates and projections. But with that is essentially another catalyst which could fuel the wage growth in which we're seeing, and again that challenge which the Federal Reserve are going to have to navigate. And it'll be really interesting next week to see how they discuss this. I think it's in terms of that number, what are the sort of sectors you see in employment growth occurring?
Yeah, absolutely. So it's primarily in the services sector actually. So the likes of leisure, hospitality, actually you've seen now retail as well, growing jobs. So really the services sector that's leading that, and the surveys suggest that we'd expect that to persist as well.
Yeah, it's quite interesting. We've seen two almost conflicting surveys come out of the US as well in terms of manufacturing. In one report, we're seeing leading indicators suggest that manufacturing businesses have got more appetite to take on workers, whereas in other surveys, you're seeing new orders, which are actually starting to cool down a little bit. So it is quite a challenge in terms of the leading indicators, but generally what we're seeing across the piece is some more supportive manufacturing data, and in that we are starting to see improvements in terms of the appetite for businesses to invest, the appetite for businesses to take on workers in order to support that demand, which is supporting this breadth we're seeing in terms of economic growth, but also how that's feeding through into asset markets as well, a bit broader in terms of the returns which we're seeing outside of the US in services and technology, which is encouraging for diversified portfolios as well. So in terms of what we're seeing in asset markets, it was all going very well for equities and bonds through the first part of the week, but just literally in the last few hours we've seen a stronger employment report which is actually pushing bond yields higher, and we've seen equity markets react on the back. So just giving back some of the gains which we were making through the course of the week, but a lot of data, it was always going to be volatile from that perspective. But encouragingly, underpinning a lot of these themes, we're still seeing signs of a robust economy. We're still seeing inflation, which is trending in a range in which asset markets can digest pretty well, and what's encouraging as well as some of the breadth which we're seeing in terms of economic growth signals and market returns as well. So that was a great roundup, quite a lot to cover there, so I thought you did a great job, Faye. We'll give you a full review in terms of the weekly delivery in our Morning Markets update next week. So please do tune in next week for Morning Markets, and we look forward to catching up next week in the Week in Review as well.